Hi, everyone. This is Dr. Duru from Ahan Analytics with the Market Breath. I'm taking a quick pause from the tariff news deluge to just talk really quickly about what I'm seeing in the market. Once again, this is the snapshot in time. These are the main headlines from Yahoo Finance. The big thing that happened today was that we have retaliated against China's retaliation on tariffs and have gone up to 104%. It brought a quick end to a soaring rally that looked like good follow through to the bullish engulfing bottom that I pointed out for Monday. So today's wild whipsaw action was a great reminder that the technicals can take us so far, but from left field, we can always get hit by macro news or any kind of news. To the extent the market can foresee these things, then the technicals will give us an edge. But to the extent the market doesn't see it coming, then technicals will be accordingly or to the same proportion not as useful. So, anyway. Let's go ahead and do a quick dive in. Let me go to my favorite technical indicator, the percentage of stocks trading above their 50-day moving averages. Um, you can see here that market breadth closed at the low and closed right at yesterday's intraday low. So we're right back to these super extreme levels. One thing I forgot to mention the other day is that at these levels of oversold, going down even further really isn't meaningful. I mean, pretty much the entire market is oversold. So if we get more oversold from here, 0% is the lowest we can go, of course. So there's not a lot of information here. So now it's all about the duration. The longer we stay in oversold conditions, the worse we can expect the stock market to perform. I mean, I know that probably seems obvious to those who are doing the math in their heads, but I just wanted to point that out. Similarly, for the percentage of stocks trading above their 200-day moving averages, it too moved close to the intraday low from yesterday. Now, the key thing that was missing from today's action for me in terms of being able to have some faith in a sustainable low is that the VIX was imploding just as I would want it to do. And I was actually doing some trades, and I'll explain to you some of my strategy on those trades. But then the macro news hit, and of course, the VIX reversed course, and now we are once again lacking the VIX implosion that we need to really be confident in a sustainable low. And again, I'm being very careful not to call the bottom, just a sustainable low, because we can't really know what the bottom is until we look back in time. Okay, let's go to the indices really quickly. As you can imagine, with the VIX, the volatility index soaring back up, we also had our indices reverse course. You can see here how we gapped up, which was great, but then reversed course eventually. Actually, let's take a look at the intraday just so we can pinpoint exactly when we had the reversal. So you can see we gapped up and we enjoyed gains for the first, what is this, 45 minutes of the day, and then it was selling almost nonstop the rest of the day. So that gives you the context there. So unfortunately, the end result was the S&P 500 lost 1.6%. We didn't, the bottom is the sustainable low is still in place because it didn't breach yesterday's intraday low, but you can see how the 20% off all-time highs is still beckoning for the conventional definition of a bear market. The NASDAQ, at one point at the gap up, conquered, got back to its conventional definition, but then acting like resistance, the Nasdaq couldn't make any further progress and went right back down. The only saving grace is that, like the S&P 500, it did not violate yesterday's intraday low, so the sustainable bottom or sustainable low is still in place. The Nasdaq lost 2.2% on the day, and then we have IWM, the small caps, same story. It didn't violate yesterday's intraday low, but this pre-pandemic high as support is still beckoning. Okay, so let me just really quickly talk about a few charts. I notice IBM is one of the few stocks still holding above its 200-day moving average. It's on my list of AI stocks. So now I'm going to put it on the buy list because in a bounce, IBM could perform pretty well. But I'm not really interested in buying or speculating on IBM below the 200-day moving low. Now, the biggest shocker, perhaps for the day for a lot of folks, as we know, the administration is targeting lower interest rates. But since Friday, TLT, which is kind of like a proxy for long-term yields, has plunged. And it's even broken down below this line that I drew as potential trading range. So now we have rates going higher, stocks going lower, and this is like a very toxic combination. If rates don't turn around soon, we could definitely see stocks go a lot lower from here. I had TLT puts in place. I bought them late in February. I accumulated them. So I experienced a lot of time decay as TLT churned. So where I sold really just gave me minimal gains. And so this is just a lesson again in how you can be correct in direction eventually, but wrong in timing. So I will once again be looking to fade rallies on TLT, but now my lesson is to kind of be a little bit more patient on the timing of my fades. Okay, now as you can imagine, with interest rates, long-term interest rates going higher, interest rate sensitive sectors like the home builders really got punished. I mean, ITB, I'm a holder in ITB, dropped another 3.6%. Um, it hasn't been this low since November of 2023 when the home builders are bouncing out of a major low. This is very bad news for not just home builders, but actually for the economy because if I had been talking about this more earlier, weakness in home builders can become a leading indicator of future weakness. And you can see here how ITB was very weak in December. Yes, it had a pop in January, but its weakness started ahead of the major weakness in the stock market. So I'm really worried again that if things don't turn around quickly for rates, home builders will sink further, and that will be a potential fresh warning sign for stocks. So remember all of this context. Now, on the speculative side, we have Bitcoin, which also has started to weaken again. This is very bad news for risk assets. You can see here Bitcoin is now back to where it was at the close of the post-election high. So the election was on the 5th of November, and on the 6th of November, Bitcoin soared 9%. Now, given the way everything has been going in the markets, we should pretty much expect Bitcoin to reverse all of its post-election gains in due time. So that would take it back to about 67,700 or so. So that's my downside target on Bitcoin. But again, the concern I have is that if indeed crypto is going to keep going down, that's going to be another bad signal for risk assets, as Bitcoin has been pretty well correlated with risky speculative assets in particular. Okay, so let's talk about the tariff crash trading plan that I put in place a while back. I have a link that I'll put in the caption as well to that. I just want to adjust it by talking about a scenario I did not talk about before, which is what happens if you're not fully positioned before a big bounce starts. And I'm going to use this stock Flex as an example. I did buy Flex today, but I did not chase it. So it got on my list because it hit a bullish engulfing pattern. Again, go to my last video to get an explanation on this. And then Flex gapped up. Let's see, it opened at 29.40. So, it gapped up about a point and a half, which is a pretty large gap. It closed the gap from last week. Sorry, it closed the loss. Yeah, this gap from last week. So it's a pretty sizable move. But in an oversold bounce, you really don't want to chase anything because at any time buyers can get exhausted. And in this case, buyers got exhausted because of the macro news on retaliation against China's retaliation. So at the end of the day, Flex ended up losing 1%. What my trading strategy was in this case was to set my buy limit about halfway between where Flex opened and where it closed the other day. So that was around here, like at 28.5. So of course, my limit order got filled, and it did at least I didn't lose all of this part of the candle if I had been chasing the open. But of course, I am down about 1%, a little over 1%, I think maybe 2% because the stock continued to slide. Now, I sized my position so that I can hold on until at least until this point, which is the presumed low, sustainable low. And that's, below this, I would have to stop out of my short-term trading positions just because a trade below, or particularly a close below this level, would then invalidate the bullish premise that I have in place. Okay, so that's the adjustment to the tariff crash trading plan. If you have any questions, as always, put it in the comments. Like and share this video so that the algorithm knows that this is content other folks should see. And in the meantime, you can also read more details on my blog at drduru.com/122, all letters. Thank you for checking this out. Subscribe to the channel, and I will see you again the next time.